Welcome back to Peter Meow Crypto Analysis and Scenarios. This video is for educational discussion only. It is not financial advice, and it is not a recommendation to buy, sell, or short any asset or platform. Now let's get into it. Recently, the SEC suddenly slowed down its push around tokenized stock trading. At first glance, this looks like another boring regulatory delay. You know the usual questions. Is a tokenized stock actually a stock? Does the holder get dividends? Does the holder get voting rights? Who holds the real shares? Who handles custody, taxes, freezes, compliance, and investor protection? All of that matters. But I think the real story is much bigger. This is not just about whether Apple, Nvidia, Tesla, or an ETF can be turned into a token. The real question is, who gets to control the future of on-chain US equities? Because tokenized stocks are not just a technology upgrade, they could become a new global distribution layer for US assets. Think about it. If US stocks, US treasuries, money market funds, and ETFs can move onto public blockchains, then users around the world may only need a wallet to access dollar-based assets. That means more demand for US equities, more demand for US treasuries, more use cases for dollar stablecoins, and more financial activity priced, settled, and collateralized in dollars. So this is not just stocks on-chain. This is the dollar system putting on a new skin and moving into crypto rails. And that is where things get interesting. The United States probably wants dollar stablecoins to expand globally. It probably wants stronger demand for treasuries. It probably wants global users to keep buying US assets. But it may not want the trading layer, leverage layer, settlement layer, user data, and price discovery layer to be controlled by platforms outside the US regulatory system. Imagine this. The underlying assets are American. The brand power is American. The global demand is for US stocks and US dollar assets. But the fees, traffic, leverage, market making, data, and price discovery all move to platforms outside the US system. That is a very different game. It is like America builds the orchard, grows the fruit, and then someone else shows up with a basket right before harvest. So in my view, the SEC's delay does not necessarily mean tokenized stocks are dead. It may mean the opposite. This market is too important to let it grow in the wrong direction too quickly. The message may be, yes, stocks can go on-chain, but not in a completely uncontrolled way. Yes, global distribution is attractive, but the rules cannot be written by offshore markets first. Yes, innovation is welcome, but a parallel US stock market cannot simply appear outside the existing system. Going forward, I think we will see two different paths. The first path is the regulated path. In this model, the real stocks stay anchored inside the traditional securities system. Exchanges, clearinghouses, custodians, transfer agents, and regulated brokers. The token is just a blockchain representation of that asset, and that token will come with restrictions, whitelists, blacklists, freeze functions, redemption rules, KYC requirements, compliance checks, tax reporting. Is that the pure Web3 dream? Not really. It is more like a token wearing a suit, carrying a briefcase, and traveling with 3 lawyers. Not very sexy, but it is probably much easier for regulators to accept. The second path is the offshore or synthetic path. In this model, platforms may create products that track the price of US stocks or ETFs, but do not give full shareholder rights. No real voting rights. Maybe no direct dividends. Maybe no direct redemption into actual shares. What users get is price exposure. That can be fast, convenient, and globally accessible, but it also comes with bigger risks. Platform risk, liquidity risk, depegging risk, legal risk, and the classic problem. You thought you bought a stock, but maybe you bought something that only looks like a stock. It is like ordering a Wagyu-style burger. It might taste good, but it may not actually be Wagyu. So the real competition is not simply who can issue a stock token. Issuing a token is easy. The real battle is who can legally issue it, who can custody the real assets, who can handle redemptions, who can process dividends, splits, halts, and corporate actions, who can connect stablecoin settlement, who controls the user gateway, and who controls global price discovery. That is the real business. So who benefits? I see 5 main groups. First, major smart contract chains, especially the Ethereum ecosystem. If securities move on-chain, they need a trusted settlement layer. Institutions care about security, liquidity, custody, support, standards, and ecosystem depth. In simple terms, if real-world assets move on-chain, they need land to live on. And the most valuable land is usually in the financial district. Second, Oracle and interoperability infrastructure. A tokenized stock is not just a token. Stocks have prices, dividends, splits, halts, mergers, delistings, and corporate actions. All of that information has to reach the blockchain correctly. If the chain says everything is normal, but the real-world company just split its stock, that is not innovation. That is a financial car crash. So, reliable data layers, oracles, and cross-chain messaging become critical. They are like the electricity and plumbing of on-chain finance. Nobody talks about them when everything works. But when they fail, the whole city goes dark. Third, real RWA issuance and distribution platforms. Not every project with RWA in its name will win. The winners need real assets, legal structure, custody, compliance, and distribution. The first big wave may not be individual stocks. It may be treasuries, money market funds, and ETFs. Why? Because they are easier to regulate, easier to understand, and more directly connected to dollar stablecoin demand. Fourth, on-chain lending and collateral protocols. The real power of tokenized assets is not just buying and selling. The bigger question is, can tokenized treasuries be used as collateral? Can ETF tokens enter on-chain credit markets? Can stablecoins be borrowed against real-world assets? Once these assets become collateral, DeFi lending protocols can benefit from a much larger collateral base. Because in finance, assets become much more powerful when they can be borrowed against, lent out, and combined with other assets. That is when they become financial Lego. Fifth, regulated dollar stablecoin ecosystems. This may be the most important part. If tokenized stocks, treasuries, and ETFs grow on-chain, what will people use to settle trades? Most likely dollar stablecoins. So while the headline is about tokenized stocks, the deeper story may be about expanding the use case for dollar stablecoins. Stocks are the headline. Stablecoins may be the main character. Now, who may come under pressure? I will not name specific platforms. Let's talk in categories. First, offshore trading networks that are outside major regulatory systems. If they try to define the trading standards for tokenized US stocks, treasuries, commodities, or indexes too quickly, especially with high leverage and 24/7 global access, they may attract more regulatory attention. Because this is not just about trading, it is about price discovery. If global markets start pricing US stock exposure on-chain over the weekend, and then traditional markets have to react on Monday, traditional exchanges will not be thrilled. Second, synthetic asset platforms with weak rights and aggressive marketing. If a product looks like a stock, sounds like a stock, and is marketed like a stock, but does not actually provide real shareholder rights or clear redemption, that is risky. You can say it is beef-flavored instant noodles, but you should not sell it like a steak. Third, platforms trying to build a parallel securities market outside traditional infrastructure, especially if they combine real-world asset prices with high leverage, perpetual contracts, anonymous access, and global distribution. These platforms may grow fast. They may look exciting, but growing too fast also makes you very visible. And being too visible can be dangerous. Fourth, RWA projects with only a narrative and no real asset capability. RWA is not magic. You cannot just add real-world assets to a pitch deck and call it the future of finance. Real RWA needs legal structure, custody, audits, compliance, redemption, settlement, and distribution. Without those, RWA may end up meaning really worthless asset. That is a joke, but only partly. So here is my conclusion. The SEC delay does not mean tokenized stocks are finished. It may mean tokenized stocks are becoming too important to ignore. The likely path forward is dollar stablecoins become the cash layer. Tokenized treasuries and money market funds become the safe asset layer. ETFs and blue-chip equities become the risk asset layer. Major chains and LWS handle settlement and distribution. Oracles, custodians, brokers, and compliance gateways become key infrastructure. And platforms that move too fast, too aggressively, and too far outside the system may face pressure. So this is not just about putting stocks on-chain. This is a battle over the future operating system of on-chain dollar finance. Whoever controls issuance, custody, settlement, stablecoins, price data, and global distribution may become the real winner. And the biggest risk is not innovation itself. The biggest risk is trying to build a new parallel market before the rules are written. That is why the SEC's sudden break may be much more important than it looks. Again, this is only my personal analysis based on public information and logical speculation. It is not financial advice. Crypto assets and tokenized financial products are high risk, so always do your own research and manage your risk carefully. Thanks for watching. If this was helpful, please like, subscribe, and share. See you in the next episode.